Hey, what's up everyone? Welcome back to the channel and I hope you're all doing well. In this video, I'm going to go over my 5 dividend stock picks for the month from the hundreds of stocks that I look at that trade on the TSX. I'm going to cover their recent financial figures, their valuation metrics, and provide my analysis on why they're my picks for the month. So make sure you stay tuned for the entire video. I'm also going to provide recent business updates so you have an idea on where these stocks are potentially headed next. Let's jump right in. The first stock up is CCL Industries, ticker symbol CCL.B. If you're looking for a solid industrial play, CCL is the way to go. And if you've never heard of them, what do they even do? Well, they're in the packages and labels business. In theory, it's a very boring business. Think of like cardboard tubes, labels, cardboard boxes, packaging foam, and cosmetic labels, just to name a few. And that's exactly what you want from a dividend stock. A stable, boring, but growing business. That way it can bring you growing dividends year after year. CCL is an often overlooked stock. However, I think this could be a potential top performer, even though other investors may have not heard of the name. And why it's a top performer? I'll tell you exactly why. But before we get to that, it's currently trading at $65.70, has a market cap close to $12 billion, and a dividend yield of 1.28%. In the last 1 year alone, the stock has gone up 36.7%. And the last 5 years, it's gone up almost 35%. And taking a look at the analyst recommendations, 6 out of 9 analysts have given this a buy rating. It has plenty of upside, as it's currently trading below its lowest price target. This is an overall great pickup at the current trading price. Great stock with plenty of upside to come. The pandemic did hurt CCL's core businesses like it did with many other businesses. Economic activity dropped, and investors wondered what's going to happen to the business model over the coming quarters and the coming years. However, CCL has shown why exactly it's a top performer on the TSX, and that's because of its close ties to the e-commerce sector. And as we all know from buying random things on Amazon almost every day, that online shopping requires a ton of packaging. It's good to be in the labels and packaging business if you're a CCL or a CCL shareholder. CCL's recent free cash flow figures are impressive. The company brought in close to $600 million over the last 4 quarters, growing its cash flow by a whopping 31%. And given the company's current market cap around $12 billion, that's an impressive cash flow yield. There's likely more dividend hikes on the horizon for CCL shareholders. Taking a look at the business behind CCL, it employs 22,000 people worldwide, with over 190 production facilities in over 40 countries. And even at that massive scale, the company is still seeing some incredible growth. Sales are up 22% year over year, and EBITDA is up 31% year over year for 3 months ended June 30th. This is a well-diversified business across North America, Europe, and the emerging markets. Let's face it, you need labels and packaging no matter where you are on this planet. And CCL has been a top performer due to its exposure to foreign markets. It's been generating strong results in China and overseas, and this profitability has improved its cash flows. And if you're bullish on the strong recovery of global supply chains, you may want to consider CCL. This stock has so much more potential as global supply chains become even more streamlined. Labels and packaging aren't going everywhere. In fact, if anything, we'll be producing even more labels and more packaging as e-commerce continues to grow. In my view, if you're a long-term investor, you don't want to ignore this company given its current valuation. By the way, if you're new to the channel, you've seen my content before, do me a favor, hit that like and subscribe button. It does 2 things. 1, it lets me know to produce more content like this, and 2, you don't miss out on future stock picks. Stock number 2, Dollarama, ticker symbol DOL. Almost everyone at some point in their lives have shopped at a dollar store, and recently that go-to has likely been Dollarama. Dollar store retailers have attracted a wider pool of customers over the past decade, and with competitors of Dollarama raising their prices, this will drive even more Canadians to Dollarama locations. Just in their first fiscal quarter of 2022, they have grown their sales 1.6% to over $1 billion. Considering the challenges of lockdown and various restrictions, those are some impressive results. It's currently trading at $56.89 and has a market cap around $17 billion. It has a dividend yield of 35 basis points, but an impressive 5-year dividend growth rate of 7.6%. In the last 1 year, it's gone up 12.4%, and in the last 5 years, it's gone up close to 67%. Looking at the analyst recommendations, 11 out of 15 analysts have given this either a buy or a strong buy rating. And given that the current stock price is still below the average price target, that means there's still plenty of upside given its current valuation. To To me, this is one of the best stocks in Canada, and it just so happens it's in the retail sector. And Dollarama is an excellent long-term growth stock as it's continuously expanding its operations. Not only is it a terrific growth stock, but it's also an amazing dividend stock where you can expect both capital appreciation in the stock price and a healthy growing dividend for the years to come. And check this out, over the last decade, Dollarama has returned over 950% total return with shareholders. That's a compound annual growth rate north of 25% on an annualized basis. And it's achieved these strong results due to both strong execution and several tailwinds. For example, Dollarama has been growing its store count significantly as well as improving its merchandising to incentivize customers to spend more each time they come through those doors. And these days with inflation rising so rapidly, no doubt Canadians will be looking for the most bang for their buck, especially when buying essential goods. And dollar stores are going to majorly benefit from this trend. And if you're looking for one of the best Canadian stocks to buy right now, Dollarama is an incredible long-term investment. It has an incredible Canadian growth story from what started out as a single price point retail chain in 1992, growing close to 600 stores in 10 provinces, to targeting 2,000 stores across Canada by 2031. Today, it's the largest and only national dollar store chain in Canada, with an average of 10,300 square feet per store, offering a broad assortment of everyday essential goods. It has seemingly a simple but growth-oriented business model, delivering superior financial results, strong brand recognition and reputation for delivering value, unrivaled presence across Canada, and a consistent in-store shopping experience no matter what store you go to. And more recently, it acquired a 50.1% equity stake in Dollar City. So you get the benefit of owning two high-growth dollar store chains with just one stock. Next stock up, Transcontinental Inc., ticker symbol TCL.A. And this is the third undervalued stock that I'm going to zero in on today. And this Montreal-based company is engaged in the flexible packaging business across Canada and across the world. And I'm expecting the demand for sustainable packaging to grow multifold over the coming years. And many businesses have already started their shift to more recyclable friendly options. It's currently trading around $20.63 with a market cap close to $2 billion. Has a dividend yield of 4.36% and a 5-year dividend growth rate close to 5%. In the last 1 year alone, this stock has gone up 26.7%. In the last 5 years, it's gone up over 17%. And if you take a look at the analyst recommendations, it's a mix between a buy and a hold. And one of the analysts covering the stock has given this a strong buy rating. And if you take a look at the price targets, the current stock price is trading less than the lowest price target, meaning there's plenty of potential upside given its current valuation. Transcontinental is a very overlooked dividend aristocrat, and it's one of the top TSX performers of 2021, and it's only trading around $20 a share. That means you can lock in a yield of 4.4% for the long term. This is a multi-billion dollar operation that's been around for over 45 years, considering it started off in the printing business. But it's a much different business than what it was when it first started. It's focused on the education publishing sector and the flexible packaging options. Not only is Transcontinental Canada's largest printing company, but also North America's largest leading flexible packaging company. And if that wasn't enough, it also dominates Canada's specialty media business. It has been growing its dividend for the last 19 years. That's an 11% CAGR since 1993. And it's on track to becoming a market leader in flexible packaging, not just in Canada, but across North America. Solid financial position and a strong predictable cash flow provide it with the flexibility to accelerate its growth both organically and through acquisitions. This company is just checking off all the right boxes for long-term investors. This is a global operation with 3,800 employees worldwide delivering value to shareholders, 26 production plants, and over $1.4 billion in revenues. Sustainable packaging is becoming a key differentiator for any business, and long-term opportunities for the business will be driven by demand for sustainable packaging options. It has successfully completed a series of 9 acquisitions to build a leading North American packaging platform. Their packaging can be found everywhere in agriculture, beverages, dairy, coffee, consumer products, pet foods, medical, and the list goes on. Let's face it, there are so many benefits of having more sustainable packaging options. It creates less waste, it's better for the environment, and also a good way to make use of our planet's limited resources. Sustainable packaging will go a long way in reducing food waste. When you look at all these factors and more, TCL is an all-around growth company. It pays a great dividend and is trying to create a more sustainable environment. This is definitely worth a look for long-term investors and ESG investors. My fourth pick, Waste Connections, ticker symbol WCN. And as the name suggests, Waste Connections collects, transfers, and disposes of non-hazardous waste in both secondary or exclusive markets. And given the essential nature of this business, Waste Connection delivers strong financial results irrespective of economic cycles. And apart from organic growth, Waste Connection also focuses on strategic acquisitions to expand its geographical presence and to build up its market share in this very lucrative industry. And just in 2021 alone, it has already completed 16 acquisitions. It's currently trading trading at $161 per share with a market cap close to $42 billion. And even though its dividend yield is only 64 basis points, it has delivered a 5% dividend growth rate close to 15%. In the last 1 year, the stock has gone up 15%. In the last 5 years, the stock has gone up close to 150%. And when you take a look at the analyst recommendations, this one is easy. You won't see many stocks with a buy and a strong buy rating across the board. And even though the stock is trading around $160 a share, it has plenty of upside considering the average price target is $192 a share. And the high price target is close to $228 a share. There's just so much potential upside from this dividend growth rockstar. As long-term dividend growth investors, one of the key metrics you should be focusing on is the dividend growth rate. And over the long term, it's actually better to go with a lower yielding stock with a high dividend growth rate than a high yield dividend stock with a flat or no growth rate at all. For WCN, they have increased their dividend by over 10% every year for the last 10 years. And this dividend growth rate is just one side of the total return story. The other side is capital appreciation. Since 2009, WCN has delivered a total return of 950%. That easily beats the TSX in that very same time frame. And hear me out, even though that the stock is trading over $160 per share, but don't get too caught up in the stock price itself. Because the stock price is nothing more than just a mathematical calculation based on the outstanding number of shares a company has. So you honestly can't compare WCN to a stock that's trading around $20 a share. It's like comparing apples and oranges. Because what you can get from WCN, you may not be able to get from other companies. And that's a recession-proof business, high growth, and a fantastic dividend growth rate. And I get it, WCN may not be as cool as the next biggest tech stock, but for dividend growth investors, you want stability, you want growth, you want a boring, stable business. And WCN is involved in exactly those activities, like leasing out dumpsters and trash compactors, collecting garbage, and disposing of hazardous waste materials. And over the years, Waste Connections has carved out an impressive, lucrative niche for itself. And for dividend growth investors, that's a good thing. And WCN is one of the few public companies giving you exposure to this unglamorous but super lucrative industry. And it's one of the few industries that can actually do well during a recession, because waste disposal is a recession-resistant, non-cyclical industry. Just think about it, even when times are tough and people are out of work, just as the pandemic has shown us, people don't stop consuming. They may consume cheaper goods, but they still generate waste. And the waste management business remains a solid sector even under difficult economic circumstances. Just take a look at these recent earnings. $1.53 billion in revenue, that's up 17.5% year over year. $177 million in net income, close to $500 million in adjusted EBITDA, and a 38.4% adjusted EBITDA margin, close to $850 million in cash from operations. That's close to $600 million in just free cash flow alone. These are solid results and they show improvement year over year. Last stock up, Cogeco Inc., ticker symbol CGO. Sometimes the best stocks are the ones that are often underestimated. Sometimes investors need to dig a little deeper to recognize an opportunity others have missed. Cogeco is a Montreal-based company that operates in the communications and media sectors across North America. It provides internet, video, and telephone services to both residential and corporate customers across North America. The stock is currently trading around $9 a share and has a market cap close to $1.5 billion, a dividend yield of 2.42%, and a 5-year dividend growth rate just under 12%. In the last year, the stock may have only gone up 2.1%. In the last 5 years, the stock has gone up almost 75%. And when you take a look at the analyst recommendations, it's rated as a buy. And notice how the current trading price is below the lowest price target. And in my opinion, it's currently undervalued. And I see a lot of potential upside with a price target of $140 per share. Let's talk about the corporate structure for a second. It's still run by the Audette family, one of the richest families in Canada. And as a shareholder of CGO, you get to be part of this elusive ownership group. Cogeco generates about $2.6 billion in revenues. It has equity stakes in Cogeco Communication, which is a separate public company, and Cogeco Media, which is a private company. So when you buy shares of CGO, you own the parent company with other underlying businesses that are revenue generating. And you might think that the telecom industry in Canada just belongs to the big three, Bell, TELUS, and Rogers. Is there room for Cogeco to even grow? And the answer may be yes. No, there isn't enough room in Canada, but definitely south of the border. And that's where Cogeco has focused its business. In 2012, Cogeco purchased Atlantic Broadband for $1.4 billion. And last year, it acquired Metro Comcast out of Connecticut for about US $200 million. And there is still a massive opportunity to grow the cable system in the US, even though you have the likes of Netflix and Disney+. Because Cogeco has launched its own TVO PVR service, allows customers to watch their shows on their own schedule. Cogeco welcomes technology and disruptive activity because it improves society and moves it forward. They've acquired 6 broadband companies in the US since 2012. spending over $5 billion. And recently, they're in talks to acquire a broadband system out of Ohio, which serves close to 200,000 customers, set to close in Q1 of 2022. This is a company that's still on growth mode, and best of all, more customers it acquires, the more revenue it generates, the more dividend it can pass on to investors like you and I. Thank you so much for watching. This channel would not exist without your love and your support. If you've enjoyed this video or any one of my other videos, consider hitting that super thanks button on the bottom of this video. It's a new way to directly support your favorite content creators on YouTube. Or if you'd like, you can buy me a virtual coffee as another way to support my content and the channel. All proceeds will be used to bring you even more value-added content that I hope will leave a lasting impact on your investing journey. So if that sounds good to you, check out the link in the description of this video to buy me that virtual coffee. And on that very same page, you can download my custom-built Excel-based dividend portfolio tracking spreadsheet, which I use to track my own dividends, forecast my dividend income, and track my gains. So you can keep track of your portfolio exactly the same way I do. If you have questions for me, feedback on this video, or maybe you have ideas on future content, let me know your thoughts in the comment section. And while you're at it, make sure you've hit that like and subscribe button, or that thanks button. That's it for now. I'll talk to you in the comment section.